Hi, I'm Monk and this is the Monk Way. Let's look at the best dividend stocks to invest in. These tend to be safer companies with lower movements, but the advantage is guaranteed money coming in every year, and they tend to not drop as hard in a market crash. We'll only look at very blue chip companies with a long history of payments and a good dividend yield. This should give you some good options to look at for the safer part of your portfolio. But I'm not recommending you buy any of these, but look into them. Subscribe, hit the bell, and leave a like for more investing videos. I make these every day. And if you want to learn more about investing, check out my completely animated course below. There's over 24 videos just like this one, teaching you everything about the stock markets, from basics to swing trading. 50% off for the first 10 buyers using the link below. I also recommend two of my favorite investment apps. Webull lets you buy stocks after hours. That's 9 extra hours of trading. M1 Finance lets you buy partial shares of big stocks like Amazon for only a penny. These are the apps I would personally use to trade. Let's have a quick refresher on dividends. A dividend is a part of a company's profits they pay back to the investors. This is paid every 3 months, also known as a quarter, and some companies pay every month, but that's rare. As a simple example, Apple stock currently pays 1.37% dividends. This means you get 1.37% of your money back every year, just for holding their stock. Let's say you have $1,000 of Apple stock, or 5 shares. You will make $13.70 per year. A very simple concept. If the dividend percent is higher, you get paid more. A 1 to 2% dividend is very usual. 3 to 5% would be higher. And higher than 6% is rare. Dividends are not 100% guaranteed, so watch out for very high dividends. A company paying out 10% a year might not be able to afford it. These companies pay dividends to attract investors, and to keep their current investors happy. If you are comparing two similar stocks, and one has a higher dividend, it might seem more appealing. These companies tend to move slower, so they drop less in the crash. These dividend payers are the safer part of your portfolio. Now we know the basics of dividends. What factors should we look at when buying one? We can't just pick random stocks just because there's a 4% dividends. Factor 1. A history of on-time dividend payments and increases. Because dividends are not guaranteed, we can look for companies with a long history of payments. A company that has paid dividends for 50 years is likely to keep paying, and a company that has raised dividends yearly is doing something right. There's actually a list of aristocrats that shows you the companies that raised their dividends for 25 years or longer. We'll be picking from that list. Factor 2. They're not paying too much in dividends. This money is paid from the company's profits, so we can see how sustainable this is by looking at the payout ratio. This is the percentage of profits they're using to pay you. 100% means they're paying out all their profits. This is not sustainable. 50% or higher is not a good sign. Under 35% would be very good. So we want a company paying less of their profits, but still paying a pretty good dividend. Factor 3. The company is still a good value. We can't just look at their dividends when buying a stock. We should still value the company first. This means having good profits, good revenue, and good money. A blue chip company with a nice PE ratio is a good start. If you use all 3 of these factors, we should be able to find some good companies. I'll compare 2 companies in the same sector and tell you the one I prefer. The first company is one we all know, PepsiCo. Even though I like Coke more as a drink, I think PepsiCo is a better deal. We'll see why after. This company has a 2.77% dividend, so $2,770 a year on $100,000 invested, up 28% in the past year, 48% in 5 years, and 131% in 10 years. They only dropped 31% in the last market crash. Compare this to Coke, which is up 100% in the past 10 years, with a 2.97% dividend. So does PepsiCo pass the factors I listed? They actually grew their dividends for 46 years straight. This is definitely healthy growth. And factor 2, are they paying too much of their profits? They're actually paying out 68% of their profits as dividends. A bit high, but obviously sustainable for the past 46 years. Compare this to Coke, at 77% payout ratio. That's really high. And 3, is this a good value as a stock? This is why I prefer PepsiCo to Coke. Outside of similar dividends, they're a better value. PepsiCo has a low 15.7 PE ratio, low 2.7 price to sales, but fairly high debts at a 2.4 DE ratio. Compare this to Coke, 32.8 PE ratio, 7.0 PS ratio, and similar debts at 2.3 DE ratio. PepsiCo is making twice the profits and over twice the revenue, giving them a lot more room to grow. So even though I drink a Coke every single day, I'll have to go with PepsiCo as a company with better numbers. If you're learning something so far in this video, please leave a like below. These animation videos actually take me more than 10 hours per video. This video alone took 2 hours on the script and research, 2 hours to record and edit, and 4 hours to animate, just these 10 minutes. Just hitting that like button really helps out the channel. And subscribe too if you want to see more videos like this. I also reply to every single comment. Next, we can compare 2 stocks in the discount retail sector, Walmart's or Target's. I actually prefer Target's because of their value and future growth. Here's their charts. They have a 2.39% dividend compared to Walmart's at 1.77%. That's $2,390 a year on $100,000, up 33% in a year, 85% in 5, and 125% in 10, compared to Walmart's at 137% in 10 years. They actually dropped 60% in the last crash, but stabilizing within a few years, like the rest of the markets. Walmart did a better job last crash, but it's a bit overvalued right now. Target has dividend growth of 51 years straight. and a nice 49% payout ratio, not too high, passing the first two factors. And they're a good value right now. A PE ratio of 18.3, pretty low, compared to Walmart's at 27.1. A very low price of sales of 0.7, compared to Walmart's at 0.6. And similar debts of 1.2, Walmart is 1.0. This means Target has much more profits than Walmart's. I like both companies, but Target has a lot more growth prospects. They're expected to grow twice as fast as Walmart's in the coming years. This might give us growth in price as well as good dividends. Because Walmart is 6 times the size of Target's, their growth won't be as fast in general. But both companies are good to watch right now. Next, we'll look at the communication sector. Verizon versus AT&T stock. Both companies will benefit from 5G when it comes out in the next few years. Verizon will be my pick out of the two, with a 4.11% dividend, compared to AT&T at 5.45%. That's $4,110 a year from $100,000. Verizon was up 11% in 1 year, 25% in 5 years, and 102% in 10. They dropped 40% in the last crash, and recovered at the same time as the markets. They had 12 years of dividend growth, and a healthy 52% payout ratio. AT&T had 34 years of growth, and 58% payout ratio. In terms of value, they have a similar PE ratio of 15.7, similar price to sales, 1.8 versus 1.5. The issue of AT&T is their high debts, about $160 billion compared to Verizon at $105 billion, meaning over $55 billion more debt to pay off. This is because they bought DirecTV and Time Warner, which hasn't paid off that well. This is because cable TV is dying off. Verizon is more focused on the core business, and with 5G coming in 2020, both companies are invested in that technology. They're both interesting stocks to look at right now. Next, we have Waste Management without a competitor. People will always need their trash picked up, with a 1.75% dividend, $1,750 on $100,000 invested. They're up 31% in the past year, 150% in 5, 277% in 10. Surprisingly high growth along with their dividends, and they only dropped 30% in the last market crash. In terms of value, they're not the best, but not bad. 28.7 PE ratio. The market as a whole is 22 right now. 3.3 price to sales. 2.2 is the average. And 2.0 in DE ratio. A bit high in debts. They have 15 years of dividend growth and a 50% payout ratio. And they actually collect 30% of America's trash. And they own 47% of landfills. That's 252 landfills. A pretty nice moat. I would say this is a bit overvalued right now, but it's definitely one to consider for the upcoming market crash. A company I really like is Disney. You might want to compare this to Netflix, but Netflix doesn't pay a dividend. Disney is actually releasing their streaming service very soon. This is one of the biggest companies in the world in terms of media. They own Fox, Pixar, all the Disney movies, Marvel, and so much more. A 1.36% dividend, $1,360 on $100,000 invested, up 16% in a year, 55% in 5, and 375% in 10 years. So a growth stock as well as a dividend stock. They only had a streak of 2 years of growth, but a very low 25% payout ratio, and they're currently at great value, 16.7 PE ratio, very low compared to the average of 22, a good price to sales at 3.6, and low debts and a DE ratio of 0.5. This is a company I could feel safe owning even in a crash. It'll be impossible to find someone on this planet who doesn't know Disney, or at least one of their properties. And with one of the lowest payout ratios on this list, that dividend is very safe. Think of everything Disney has. All the Marvel movies, all the Disney movies, all the Pixar movies, many upcoming shows and movies like Falcon and Winter Soldier, WandaVision, Frozen, Mandalorian, Star Wars, Loki, and so much more. All of this on Disney Plus for $7 a month. This is half the price of Netflix. I believe their strategy and extremely high value puts this stock as one of my favorites in the market right now. Another good long-term company is McDonald's, with a 2.39% dividend, $2,390 on $100,000 invested, with 42 years of dividend increase, but a pretty high 65% payout ratio. They're up 29% in 1 year, 131% in 5, and 260% in 10. Huge gains here, and they only dropped 10% in the last crash before bouncing back. A great stock for any recession. In terms of value, their price has been going up lately, 27.5 PE ratio, 7.6 price to sales, and pretty high debts. This is a safe company with a huge streak of dividend increases. Perfect as a defensive stock for the upcoming crash. Those were the safer companies. Let's move on to 2 stocks on dips, giving them bigger dividends. AbbVie actually dropped 40% in the recent years. Now they have a 5.75% dividend, with 46 years of growth and 54% payout ratio. This is looking like a good dividend stock just based on these factors. But they're down 90% in the past year, up 40% in 5 years, and 126% in 7 years. A solid value at 27.2 PE ratio, 3.4 price to sales, and no debts. AbbVie is a pharma company that really dipped recently because one of their biggest products will be having huge competition soon. They also had bad earnings. There has been quite a bit of bad news, so you have to do your own research to see if this dip is justified. But if you buy in at these prices, you can get a very nice dividend of 5.75%. Another popular stock that dropped is MMM. They have a 3.78% dividend right now, with 60 years of growth and a 56% payout ratio, but they're down 24% in the past year, up 13% in 5, and 100% in 10 years. a good PE ratio of 18.3, price to sale of 2.7, and 1.6 DE ratio. Pretty good value here, but should you buy this company at its low price? They have a huge growth rates and only 56% payout ratio, so it's probably going to continue. But it dropped recently because of missed earnings reports, which lost on profits and revenue, and lowering future numbers too. This company is very affected by the trade war of China. Basically, their business is not looking good. But if you research this company and like their future plans, then it's not a bad time to get in. But this is the risk you have to take for high dividend stocks in the red. If you enjoyed this video, check out Monk's Market Mastery below, a fully animated guide to the stock markets, teaching you the basics to long-term investing and short-term trading. It's 50% off right now, but the sale is ending soon. Subscribe, hit the bell, and leave a like for more investing videos. I make these every day. Keep watching the Invest in Dividends the Monk way.